Next up is Rudi Fronk, who's the leader of SEABRIDGE Gold. SEABRIDGE could be the next Cobre and has an incredibly great project in British Columbia that's fully permitted. It's ready to go. It just needs to be financed. Well, Rudy's going to tell you about the size of the deposit. And I think it's very exciting, and this could be their year. Who knows?
Welcome to the SEABRIDGE presentation. First and foremost, John, thank you for having us back. I think this is the third year we've now presented, and always appreciate the opportunity. I will be making forward-looking statements during today's presentation. So why SEABRIDGE? Well, 6 compelling reasons to start off with. Number 1, reserves. Between KSM and Courageous Lake, we have 45 million ounces of proven and probable reserves, as well as 10 billion pounds of copper. Low share count. After 20 years of being in business since we started the company, we only have 61 million shares outstanding. Low valuation. I think most CEOs of gold companies think they're undervalued. If you look at our valuation relative to peer group companies, today we're trading at $18 per reserve ounce in the ground and less than $10 per total resource ounce. Low political risk. I've had mines expropriated in my career that I've built. Political risk is real. At SEABRIDGE, we tend to focus on safe jurisdictions with all of our assets either in Canada or in the United States. Exploration upside. I think that's what we've excelled on over the past 2 decades now, our ability to see opportunities and projects we acquired and then grow them through exploration activities. And last but not least, it's our ability to buy when the market is down. Paul mentioned that the big companies tend to buy assets when the market is strong, overpaying for them. We think it should be done just the opposite. And we've now had 2 tranches of acquisitions in the early days from 1999 to 2002, taking advantage of a down gold market and buying our initial assets. And then more recently, as the gold price has been knocked down again and valuations went much lower, we've completed 2 additional acquisitions that I'll spend some time on today updating you on. This is a chart that I doubt that most CEOs of gold exploration development companies will show you. It measures our share count relative to ounces in the ground. When we formed SEABRIDGE in 1999, the concept was to create what we thought would be the best leverage play to a rising gold price. Back then, gold was trading well below $300 an ounce. We took the opportunity to go out and buy assets in the ground from previous owners, including the likes of Newmont, Placer Dome, and others, and then to grow as the company evolved to grow ounces per share through our own exploration activities. By the end of 2017, we had 58 million shares outstanding and 115 million ounces of gold in the ground that we either had acquired or grew through exploration. So by the end of 2017, we had almost 2 ounces of gold per common share. And what this has translated into is significant outperformance in a rising gold market. Over the past 20 years, the price of gold is up by about 350%. Our share price is up about 2,500%. Over the past 20 years, we've outperformed the gold price by an average factor of 7. Meaning that on average, over the past 2 decades, every 10% increase in the price of gold has resulted in a 70% increase in our share price. Very few companies have delivered that type of outperformance over the past 2 decades. In fact, if you look at the go-to stocks, the Newmonts, the Goldcorps, the Barricks, and also some of the larger indices, you were better off owning physical gold over the past 2 decades than owning any one of these major gold companies, in that they significantly underperform the price of gold. We did just the opposite. Now, turning to our assets, our most significant asset, as John mentioned earlier, is the KSM project. We purchased this project from Placer Dome back in June of 2000. Placer Dome had spent about $25 million at KSM, defining 2 deposits containing 3.4 million ounces of gold and 2.7 billion pounds of copper. We bought this project for $200,000 in June of 2000. They essentially gave it to us for pennies on the dollar. Fast forward to today, we've now advanced this project through exploration, engineering, and permitting, defining today what is the largest undeveloped gold-copper project in the world today as measured by gold reserves. In addition to defining a robust project economically, we've also been able to go through the environmental assessment process. Another risk that big projects face in today's world is the risk of permitting. We spent 7 years in the environmental assessment process in Canada, receiving the approvals in late 2014, and now continue to advance the project forward through additional exploration to make the project even better than it is today. Logistically, this project has a lot going for it as well. When we bought this project in June of 2000, there really were not any existing major roads, no power, and no ports close by. Today, the Government of Canada has now built an all-year-round highway on Highway 37, going just to the east of our project. Along that highway, they also spent $750 million extending the power grid. We've now secured, through contracts with BC Hydro, 200 megawatts of power from this line, as well as applied for an additional 50 megawatts that's still available. We'll be able to buy power off this grid for about 5 cents per kilowatt hour, which is some of the cheapest power in the world, because the power that is put into this line is mostly hydro-sourced. And last but not least, just to the south of us in the town of Stewart, there are now 2 brand new port facilities that have been built that will allow us to bring supplies in by ship and take concentrate out to some smelters on the Pacific Rim. We finished our first pre-feasibility study at KSM in 2012, defining then a large project. We then started the environmental assessment process in 2013 with the official submittal and received our approvals in 2014. Between 2012 until 2016, a lot happened in the market in terms of metal prices, currency exchange rates, and others. And also during that time period, we were able to add a lot more material to the project that could be considered in a new mine plan. But we decided to update the pre-feasibility study in 2016 that defined a project with 2.2 billion tons of reserves, containing 39 million ounces of gold and just over 10 billion pounds of copper. And if you look at that mine plan back then, the all-in cost of production, including the upfront capital, the sustaining capital, the closure costs, and the operating costs net of base metal credits, was about $670 an ounce. So well below what the industry is making gold for today, but our view was that it could get a lot better. In 2013, after the first pre-feasibility study was done, we started to explore new opportunities at the project. First at the Kerr Zone, finding a deep-seated core zone to the project, and now more recently at Iron Cap. Since 2013, we've added over 2 billion tons of additional material containing over 36 million ounces of gold and 25 billion pounds of copper. At grades, if you look at the contained metal value, it's about 50% higher than the reserves that we reported in the updated pre-feasibility study. So we decided to show what this project could look like, taking into account some of the additions we had at Iron Cap. Essentially, what we're limiting ourselves to now is what we have approved as tailings capacity. Through the environmental assessment process, we were approved for about 2.4, 2.5 billion tons of tailings capacity at a specific location. So our goal now is to find what is the best use of that facility in terms of tons and grade that can be mined. So we started to factor in what could the Kerr deposit do to this project. And if you look at our revised mine plan, we're still capturing the 2.3, 2.4 billion tons of material. We're still capturing about 40 million ounces of gold. But instead of 10 billion pounds of copper, we're now capturing almost 17 billion pounds of copper, which obviously has a big positive impact on the project's economics. Essentially, what the new mine plan does, it converts a lot of material that had been mined previously as open pits to underground. If you looked at the pre-feasibility mine plan, we were mining 2.2 billion tons of ore, but that was generating about 3 billion tons of waste. By factoring in Kerr as a large underground block cave operation, we were able to reduce the waste rock from 3 billion tons to 600 million tons and capture another 7 billion pounds of copper in the process. So if you look at the mine as designed today, we're looking at a throughput capacity of about 170,000 tons a day. At that capacity, it takes us 50 years to mine the 2.4 billion tons. Recognize that we have over 7 billion tons of resources. So this is a project that's only capturing right now a third of the resource because of what we have approved for for the tailings capacity. It'll be the largest mine ever built in Canada. First 7 years of mine life, it'll be averaging over 1.1 million ounces of gold production a year and over 300 million pounds of copper. And if you look at the economics of this project with this revised mine plan, our base case using $1,230 gold and $275 copper, which is both below the metal prices today, you're looking at an all-in cost of production of about $358 an ounce. That includes the upfront capital of $5.5 billion, the sustaining capital over the 50-year mine life, the closure costs, and the operating costs net of copper and silver credits. So as a result of improving the mine plan by taking in higher grade material, the total cost of production dropped from $670 an ounce down to $350 an ounce. And we're still not yet done. The last 2 years, we've now been focusing on higher grade material at the Iron Cap deposit. If you look at the Iron Cap deposit right now in the current mine plan, only about 10% of the total production comes from Iron Cap. Over the past 2 years now, we've made significant additions to Iron Cap. In 2018, we announced an updated resource at Iron Cap, capturing an additional 14 million ounces of gold and 6 billion pounds of copper. We continue that exploration in 2018 with tremendous success, showing that this deposit continues down dip. And within the next 2 weeks, we'll be announcing what the changes are to the Iron Cap deposit in terms of resources as a result of 2018 drilling. We are confident that once again, for the 20th consecutive year, we'll be able to show that the work we did increased our ounces on a per share basis. We're not a single asset company. We also have 3 other assets that we believe can drive value as we continue forward, hopefully in a gold bull market. One of which is a project called Courageous Lake, located in the Northwest Territories of Canada. At Courageous Lake, we control a 50-kilometer greenstone belt where we have a reserve of 6.5 million ounces on only 2 kilometers of that greenstone belt. We finished a pre-feasibility study at Courageous Lake in 2012, which is the base case on this slide, that quite honestly showed a marginal project at the then gold price of $13.84 and the then Canadian dollar essentially at par with the US dollars. If you actually look at the similar mine plan and economic analysis, but put in today's gold price and today's exchange rate, what was a marginal project in 2012 has turned into a better project. Still probably not near the hurdle rates you need to get over to attract a partner or a sale, but definitely moving in the right direction. We see the opportunity at Courageous Lake, like we did at KSM, to continue exploration, looking for additional zones that can improve the mine life, adding perhaps higher grade material on the front end. And in 2014, we announced our first new resource at Courageous Lake, capturing another 500,000 ounces of gold in an open pit configuration at a grade that's a lot higher than our reserve grade. In 2018, we went back with additional drilling, looking for other targets along the greenstone belt, and found 2 new zones, the Olsen zone and the Marsh Pond zone, which again, better grades than our existing reserves, open pitable configurations, and actually simpler metallurgy. So this is a project that we plan to roll out as we go forward to do additional work on to hopefully continue to drive value. The 2 acquisitions we did recently, one was Snip Gold, buying a company that was publicly traded on the Vancouver Stock Exchange, and also another project in Nevada. The Snip Gold acquisition was interesting to us because we see a lot of similarities at their Iskut project as we were able to unlock at KSM over the years. We bought this company for 700,000 shares. Up front, we got 2.2 million ounces of measured and indicated resources, plus about 1 billion pounds of copper. It is another large porphyry system that's underexplored. Over the past couple of years, we've been looking at what are the real opportunities at the Iskut property to continue to drive value. We've done a number of drilling programs here. One of the great logistical advantages of Iskut is it's only about 30 kilometers from KSM. So actually, in terms of sharing some costs, it's worked well. Where we're going with on this now is we believe that the opportunity at Iskut is another porphyry system like KSM. Last year's drilling pointed us to where we believe the next porphyry can be found here. We'll do additional work this year through geophysics, and then probably start our first drilling program looking at the porphyry target here underneath the quartz rise top of the system. The other acquisition we did was the Snowstorm project in Nevada. This is a project that was assembled in a private company over the past 20 years, building a large land package in a really good location relative to other big mines. We bought this project from John Paulson, the hedge fund guy out of New York. We paid 700,000 shares to buy this project, as well as 500,000 common share purchase warrants. Why do we buy this one? Well, if you look at where it sits, this deposit is a bullseye of the intersection of the Getchell Trend that hosts two big mines, the Twin Creeks mine, the Turquoise Ridge mine, a Newmont mine, and a Barrick mine, as well as the intersection of the Carlin Trend, which is probably the most prolific gold belt in Nevada over the past 30 some odd years. This year, we're going to go on our first drilling program. We've assembled all the data that had been generated historically on this. We're definitely in the right rocks. There is gold in the system. This year, we'll have our first drilling program starting sometime this summer. So what drives value? Well, if you look at our relative performance over the past 2 decades, obviously the gold price. If you are looking for a leverage play to a rising gold market, I would argue that there's no better investment opportunity other than SEABRIDGE Gold because of what we've generated in the past. There's no doubt that the exploration success we've had over the past 3 or 4 years has resulted in value creation as well. If you go back and look at that chart I showed in terms of our share price performance, the last 3 years we've significantly outperformed once again other gold companies in the price of gold. I think a lot of that had to do with just the exploration success we had at KSM. We know that the most important thing that we can do, though, to drive value to our shareholders is a joint venture on the KSM asset. We acknowledged very early on that KSM is beyond our capabilities to build as a mine. It's going to involve it's going to require the involvement of one of the major mining companies, either on the base metal side or the gold side. And we're now in the process of discussions on joint ventures with major mining companies. Over the past 2 years, we have turned down 3 proposals. We only get to do this once. It's got to be the right deal for our shareholders. What we're looking for in a joint venture is hanging on to a meaningful interest in the project while minimizing our capital contribution against that investment. So stay tuned on that. Hopefully this will be the year, John. That would be nice. And why are we confident in the joint venture? Well, the elephant in the room that the majors won't speak about is their declining reserves. Paul mentioned earlier in his presentation that the major gold companies today have about 10 years of reserve life left in their portfolio. And the consolidation we're seeing going on in the space now actually makes it even more difficult. They now need to replace more reserves every year through the combination of the big companies that's happening. In the 1990s, they actually did a good job. They replaced their reserves that they mined through their own exploration activities. The next decade, it was cut in half. And over the past 6 or 7 years, they're finding less than a third of what they mine every year through their own exploration activities. And as a result, reserves are dwindling. I mean, it's no secret. They report the reserves. You can see that even though the price of gold is higher today than it was 10 years ago, their reserves are down for the most part. So what that does, it forces them to go out and find new projects. Sure, they would like to continue to find them on their own because their average cost of discovery is under $100 an ounce, whereas if they go out to have to buy assets or buy ounces in the ground, they're paying well over $200 an ounce. And just to point out, to give my exploration team a pat on the back, SEABRIDGE over the past 10 years has found more gold through its own exploration activities than Barrick, Newmont, Goldcorp, or any other gold mining company on the planet, at much lower costs than what they found their ounces for. So wrapping it up, we are dual listed, although most of our volume is on the New York Stock Exchange. We have a tight share structure, not only few shares outstanding, but insiders own over 30% of this company. I think that's another important aspect as you look at investments in junior exploration companies. What skin do the owners, do the management team have in the game? Believe me when I tell you that we think as shareholders before we think as management team. What deals are going to drive value on a per share basis? And then finally, good institutional support as well with a lot of the big institutions, including the including Van Eck, because of our involvement in the GDXJ, owning shares as well. And then finally, Royal Gold did some due diligence on KSM years ago. We actually granted them an option to buy a 2% royalty at KSM, for which they'd have to pay us $160 million in cash to exercise. And the 2% is only on the gold and the silver, not the copper. To get this option, Royal Gold invested $48 million into our treasury, buying shares at a 15% premium to market in 2010 and 2011. With that, John, I'd be happy to answer any questions. Yes.
Paulson still a major shareholder. He hasn't sold any of the shares.
No, he has not sold a share according to his recent insider reports.
Thank you.
Just how big is the universe of potential buyers? And of that universe,
That's what keeps me up at night.
yeah,
The
of that universe.
To be honest, in the gold space, there isn't a gold major that has built a mine at 170,000 tons a day throughput. They've built mines at 120 to 140,000 tons a day, so this will be larger than any gold company has ever built. Whereas the base metal companies, they're a bit different. They focus on opportunities like this, multi-generational projects. You look at KSM today, it's a project that's going to go on beyond 50 years. So in the gold space, I'd say there's 3 companies that we might consider as partners. That would be the 3 biggest companies out there, although 2 of them are now merging into one. And on the base metal side, I believe that's where we get our transaction done. And on the base metal side, there's probably 4 or 5 companies that would be meaningful partners that have the technical, the financial, and the social capabilities to take on a project the scale of KSM. And that's where I believe we'll get our deal done.
What do you believe to intelligently mine KSM? To intelligently mine KSM, what sort of dollar investment are you talking about that a partner would have to make?
The upfront capital will be about $5.5 billion. It'll take 4 years to build. But once the mine is up and running after those 4 years of construction, you're looking at the project generating about $1.5 billion of cash flow per year at today's metal prices. So on a payback period, you're going to get your money back in about 4 years or so, relative to a mine life in excess of 50 years, which only captures a third of the resource. So again, I think this project is more akin to a big base metal producer that sees the opportunity here for a mine life that can go on for generations.
Is there any expectation of being able to expand
the ability to mine, earlier rather than later with the 2.5 that you were talking about as constraint?
Great question. We don't want to scare the regulators with another tailings area. Although I will tell you that the First Nations that are fully behind the project are already pointing to this project and saying, we need to mine more of your deposits. So I think as time goes on, and you have a lot of time to actually do that, there will be other places to put tailings. Open pits is a great way to put back tailings. If you have big openings through block caves, pumping that back underground may be a better way to do it. I do believe that over time, this will be a much bigger mine than what we're talking about here today. You look at projects like this, you're looking at projects that this mine could actually produce 400,000 tons a day, or mine 400,000 tons a day of ore, which would obviously almost triple the production we're talking about already in our mine plans. But it's going to take additional capital to get there, but you don't need to do that on the front end. You have plenty of time to bring that additional capital to work in terms of expanding the mine and finding new locations for tailings.
How current is the 5.5 billion CapEx estimate?
It's still reasonable. Just last year, we had a independent audit done of that by a major engineering consulting firm, and also recognize that people have been looking under our skirt now for many years, and they've done their own due diligence exercises in assessing our capital estimates as well as our mine plans and our models. And I can tell you that we've never had really any significant pushback in terms of our capital cost estimates or our operating cost estimates.
I know this is hard to answer, but what do you think is holding people up from doing a deal?
Well, number one, we could have done a deal, but it's got to be the right deal. Understand that. But I think if you look at the universe of the prospective partners, as even Paul mentioned in his presentation, over the past several years, they've been more inward-looking. They did all these crazy deals when at the top of the gold market in 2010 and 2011, which was also the top of the copper market, taking on assets that they overpaid for. And then as the market went against them, they're sitting with all this debt, and they need to focus on cleaning up that debt and selling non-core assets. So they weren't that engaged in terms of outward looking, they were more inward looking. I believe as we go forward here now, and I think you're starting to see that in the gold space in terms of the M&A activity that we're now starting to see, that the big companies are now starting to realize, oh crap, I'm out of reserves in 10 years. I better need to start fixing that. And I think that's the kind of market we want to be sellers in, not what we've seen over the past 5 years. The past 5 years was a buyer's market, which we took advantage of. I think we're now entering into a selling market.
Rudi, if I can ask a question. The last couple of years drilling at Iron Cap has brought some exciting results, and at least rumors that maybe that would change the way that the mine plan would be developed, at least on the surface, that you might start at Iron Cap first, which is at the end of the tunnels that go to the mill, rather than the far side of the deposit, which is contemplated now in the plans. And I believe there's a PEA coming at some point this year. Is that still on track? And what kind of changes would starting at Iron Cap bring to the CapEx number?
There will be a reduction in CapEx as a result of Iron Cap because the Iron Cap deposit sits right next to the tunnel system that connects the mine to the mill that you build. Iron Cap, in our view, will leapfrog Kerr in terms of development, will have a positive impact on the project's economics. Right now, we're in the process of getting our arms around the resource update as a result of last year's drilling. We'll announce those new resources within the next couple of weeks, and then we can start to focus on what comes next in terms of looking at a further revised mine plan to bring Iron Cap into the sequencing and improve what we're already showing as a very capital efficient project. Whether we get to finish that work or not depends on what type of offers we get in terms of the joint ventures this year.
So you think it depends upon the resource announcement?
Well, I think that's the starting point. We obviously constrain our resources at the case of Iron Cap through block cave shapes that are done by independent experts. So we'll have that new resource and then start to focus on, within these resources of the cave shapes, you have high-grade zones that could be gone after first in a block cave. One of the beauties about a block cave mine relative to an open pit, you've got to take the ore as it comes from top to bottom. In a block cave, you can actually start your initial production at the sweetest part of the deposit and then work outward from there. And if you look within the Iron Cap deposit and even in the Kerr deposit, there are definitely zones there that are significantly higher grade than our reserves that you can start to focus on.
Okay, well, great. If no more questions, thank you very much.
Thank you.